Good morning. Welcome to a journey into the world of options trading. We're about to explore a strategy that can add a unique dimension to your investment toolkit. Navigating investing can feel like predicting the weather. The market, much like the atmosphere, is subject to constant change and unforeseen events. Sometimes you expect sunshine but get rain, unexpected downturns, surprising rallies. These are all part of the investment landscape. It's crucial to have strategies in place to weather these storms. Options trading is one way investors manage this uncertainty, providing tools to potentially profit in various market conditions, not just when prices are rising, offering flexibility beyond simply buying and holding stocks. Options allow you to tailor your investment approach, creating strategies that align with your specific outlook and risk tolerance. They can be used to generate income, hedge existing positions, or even speculate on future price movements. Today, we'll explore the modified put butterfly, a strategy with a name as intriguing as its potential. A nuanced options strategy for those who already understand puts and calls. This isn't a beginner's technique. It requires a solid grasp of options, terminology, and mechanics. If you're new to options, consider exploring some introductory materials first. This strategy is designed for markets where you expect little movement, where you anticipate a period of relative calm and stability. Aiming to profit if a stock trades within a tight range, it's about capitalizing on the absence of volatility rather than betting on a significant price swing. Think of it as a precise tool, not a blunt instrument. It's not designed for broad market predictions, but rather for carefully considered scenarios. Ideal for patient, detail-oriented investors. Success with this strategy requires careful planning, diligent monitoring, and a willingness to adjust your position as needed. We'll break down what the modified put butterfly is, dissecting its components and revealing the logic behind its construction. How to set it up, walking you through the steps involved in establishing the position, from selecting the appropriate strike prices to managing the trade over time, and when it might fit your portfolio. We'll explore the specific market conditions and investment objectives that make this strategy a potentially suitable choice. By the end, you'll know if this strategy aligns with your investment goals, empowering you to make informed decisions about whether to incorporate it into your overall investment plan. Let's dive in. Markets often move sideways, not just up or down. The modified put butterfly thrives in these range-bound periods when a stock bounces between support and resistance. If you expect a stock to stay near its current price, this strategy can turn market indecision into opportunity. It's a non-directional approach. Profit comes from the stock staying put, not making a big move. Before using it, ensure there are no upcoming events likely to cause major price swings. Investment returns come as income or capital gains. The modified put butterfly is all about capital gains, a one-time profit if your prediction is right. Unlike income strategies that pay regularly, this approach aims for a lump sum at the end of the trade. It's not for paying monthly bills, but for those seeking growth from a specific market scenario. Use it as part of a balanced portfolio. Combine income strategies for stability and butterfly spreads for targeted growth. Remember, the payoff comes only if the stock stays within your predicted range. It's a calculated play for a defined, potentially significant return. Volatility measures how much a stock's price swings. The modified put butterfly works best in low or moderate volatility when prices are calm and options are cheaper. High volatility makes options expensive, reducing your profit potential. Enter the trade when implied volatility is low, so you pay less for options and benefit from time decay. If volatility spikes after you enter, it can hurt your position, even if the stock doesn't move much. Always check historical and implied volatility before trading. You want a calm market with no big events on the horizon. Let's build a modified put butterfly. Use 3 put options with the same expiration date. Example, stock ABC is at £100. Buy 1 in the money put, for example, £105 strike. Sell 2 at the money puts, for example, £100 strike. Buy 1 out of the money put, for example, £97 strike. The modified part is the uneven distance between strikes, making the lower wings shorter. This tweak can reduce your entry cost or even create a small net credit. The goal? Maximize profit if the stock stays near the middle strike at expiration. This structure defines both your risk and reward from the start. The modified put butterfly offers clear, capped risk and reward. Maximum profit occurs if the stock closes at the strike price of the sold puts. Your loss is limited to the net cost of the trade. For example, if you pay £1.50 per share to set up the trade, that's your maximum risk. The most you can gain is the difference between the upper and middle strikes, minus your entry cost. If the stock moves too far from the middle strike, your profit shrinks or turns into a loss. You know your best and worst case outcomes before you enter. This makes it a transparent, manageable strategy. The modified put. Butterfly's strengths are its defined risk and low cost. You can often set it up for a small debit or even a net credit, making it capital efficient. However, the path to profit is narrow. The stock must finish near the middle strike. Large moves in either direction mean losses, so precise forecasting is crucial. The profit is capped. You won't benefit from big, unexpected stock moves. This strategy is best for stable, range-bound stocks. It's not a get-rich-quick tool, but a disciplined way to target specific market conditions. Use it when you want control and clarity over your risk. The modified put butterfly can be a powerful strategy, but it's crucial to recognize situations where it's best to stay on the sidelines. Knowing when to use the modified put butterfly is just as important as knowing when to implement it. It's about understanding the market conditions and the specific characteristics of the underlying asset. Avoid it if you expect a big move up or down. If you anticipate a significant price surge or a steep decline, the modified put butterfly's limited profit potential and defined risk range become a disadvantage. In such scenarios, you're better off employing strategies that can capitalize on directional movements. A simple call or put is better for strong trends. When a stock is clearly trending in one direction, a straightforward call or put option allows you to directly benefit from that momentum, offering a more efficient and less complex approach. Don't use it before major events. Earnings announcements, significant economic data releases, or any event likely to trigger substantial price swings should be avoided. The uncertainty surrounding these events can easily push the stock outside the butterfly's profit zone, or in high volatility markets. High volatility environments increase the risk of the stock exceeding your defined range, leading to potential losses. The premiums on options will also be inflated, making the strategy more expensive to implement. Options will be expensive. The cost of constructing the butterfly increases significantly with higher implied volatility, reducing your potential profit and increasing the break-even points, and the stock may break out of your range. If a stock is showing signs of breaking through resistance or support levels, the modified put butterfly becomes a risky proposition. A breakout can quickly move the price beyond your defined boundaries, resulting in losses. It's not ideal for long-term trades. The modified put butterfly is designed to profit from short-term price stability. Holding it for extended periods exposes you to increased risk from unexpected market movements and time decay eroding the value of your options. Time decay works best in the final 30-45 days before expiration. The strategy benefits from the accelerated time decay that occurs closer to expiration, as the value of the options contracts erode, contributing to your profit if the stock stays within your range. If you're uncomfortable managing multi-leg trades, the modified put butterfly involves multiple options contracts, requiring careful monitoring and adjustments. If you're not confident in your ability to manage these complexities, it's best to avoid this strategy. Start with simpler strategies. Begin with single-leg options or covered calls to gain experience and build your understanding of options trading before tackling more complex strategies like the modified put butterfly. This is a short to medium-term precision tool. The modified put butterfly is most effective when you have a specific price target and a relatively short time frame in mind. It's not a strategy for broad market speculation or long-term investment. Only use it when you're confident the stock will stay put. The core premise of the modified put butterfly is that the underlying asset will remain within a defined range. If you anticipate significant price movement, this strategy is not appropriate. Complexity and timing matter. The success of a modified put butterfly hinges on precise execution and accurate timing. You need to carefully select your strike prices and expiration date to maximize your potential profit. Don't force it in the wrong environment. Trying to force the modified put butterfly into unsuitable market conditions will likely result in losses. Be patient and wait for the right opportunity to utilize this strategy effectively. Let's bring this strategy to life with a real-world example. We'll walk through a scenario where a modified put butterfly can be particularly effective. This will give you a clearer understanding of how to implement it and what to look for in the market. Imagine Sarah, a savvy investor, is closely watching a stable blue-chip stock. This stock has a history of consistent performance and is known for its relative stability compared to more volatile tech stocks or growth stocks. Over the past few weeks, this stock has been consistently trading within a narrow range, fluctuating between £245 and £255. This sideways movement indicates a period of consolidation and a lack of strong directional momentum. Furthermore, the overall market sentiment is calm, and no major economic announcements or company-specific news events are expected that could significantly impact the stock's price. After careful analysis, Sarah predicts that the stock will likely remain near £250 for the next month, continuing its sideways trend. Her prediction is based on technical indicators, historical price patterns, and the absence of any immediate catalysts for a breakout. Given her outlook, she decides to implement a modified put butterfly strategy to capitalize on the expected price stability. This strategy allows her to profit if the stock stays within a defined range, with the highest profit potential at her target price. To construct the modified put butterfly, Sarah first buys a put option with a strike price of £255. This put provides downside protection in case the stock unexpectedly rises. Next, she sells 2 put options with a strike price of £250. These short puts generate income and form the core of the butterfly spread, benefiting if the stock stays near this price. Finally, she buys another put option, this time with a strike price of £247.50. All of these options are set to expire in 40 days. This long put limits her potential losses if the stock price declines significantly. Her maximum risk is limited to the small net cost of setting up the entire options structure. This is the amount she paid for the options minus the income she received from selling the puts. Conversely, her potential reward is maximized if the stock price closes exactly at £250 on the expiration date. This is where the sold puts will expire worthless and the long puts will provide the maximum profit. As you can see, the modified put butterfly is a powerful and precise strategy that allows you to profit from a specific price range. It's particularly well suited for markets that are range-bound and exhibit low volatility, where significant price movements are unlikely. Keep in mind that this strategy is primarily designed for generating capital gains rather than consistent income. Successfully implementing a modified put butterfly requires patience, careful analysis and precise timing. Therefore, use it strategically when you have a clear understanding of the potential risks and rewards, and when you want to achieve a targeted payoff within a defined risk parameter. Like any financial tool or investment strategy, its true value lies in your ability to recognize and capitalize on the right market conditions and opportunities. Understanding when and how to use it is key to maximizing its potential. Well, this is it for today. Thanks for watching and see you next time, and good luck with your trading.